3.
Hello everyone, and thank you for joining us this evening. It's the 14th of September. Happy midweek, everybody. This is me, Fok Guan, and today we are putting it all together. I want to thank you all for being here today. You could be scrolling through TikTok right now. You could be out on ladies' night, but you choose to be here today. So without further ado, let's begin. Okay, first up, disclaimer. This content here is for educational purpose only and should not be used or relied on as any recommendation or basis of investment. Okay, here's a quick recap. We started this webinar series with a fireside chat, Ask Me Anything, right? Where you get a sense and feel what to expect from the financial markets. And then we have SGX trainer Tom Yuan to give us a short introduction about basic technical analysis, enough for you to know how to read charts and look out for chart patterns. Now remember, technical analysis is a huge topic and it's normally covered in a few days. You should be doing more of your own research on this. If you're not familiar on the topic, I'll give you some keywords to search for later in a bit. And then next we had another SGX trainer, Bini Ong, teaching you risk management, what you need to be prepared for before placing a trade, your plan on how will you enter a trade and what to do if this happens and what to do if that happens. Lastly, we had Tim Phillips, our head of content and investment lead. He went through with you easy peasy, where he brought you all different investment assets such as stocks, bonds, ETFs, unit trusts, etc., and how to start building a portfolio. All that we have covered is but a small part of all consumable content out there. There will be someone out there all the time in the scene who's always trying to hype you up about what the next big thing is. And so here in today's webinar, I will teach you about interpreting information online. Interpreting information online and what you can do to get better at this. Okay, so the big question, fundamental analysis versus technical analysis. Now, fundamental analysis is when you look at the numbers, you look at their earnings, you look at their growth and their PE ratio, etc. Technical analysis is when you look at price action, which is essentially the reaction of all other participants in the market. If you ask me, fundamental is the reason why I picked the stock, while technical is how I would trade the stock. If I were to reference this with Dota, right, fundamental analysis is like understanding all the specs on all the items. And technical analysis is like studying the gameplay. Like if your enemy is missing during mid-game, high chance the enemy is fighting Roshan, right? Or they may just be at the secret shop or at one time. So you see a stock rally up all the way up to resistance, and then it forms a reversal pattern. High chance it might reverse, right? Keyword here is high chance. So what is the best strategy then? If you Google this, you'll find endless information on it. To begin, start with an end in mind. Do you plan on accumulating stock to build a dividend growth portfolio that gives you a second stream of income? Or do you see an unseen potential in a certain industry that you expect to boom in the future? Or do you simply want to partake in the changing trends of the market? Whatever the end goal is, the strategy will then be different. Some people, after buying a stock, will look at price changes every day. They start planning their holidays in the Maldives when it's up, and then they become borderline depressed when it's down. Some people can buy into a stock and not look at it for weeks to years. When they are in the money, some people will just want to take profit and run while some people will prefer to hold it to the moon. And then when you buy a stock, it drops, and some people will lose sleep and hair over it. Some people will aggressively double down into it, while some people will just sell everything. So my point is this: what works for you might not work for others. You know, in Dota, some people are so pro while playing Invoker, you can't even get near them. Master level Invokers are almost untouchable. But still, that does not mean that you can't win a match if you don't have an Invoker in your team, right? So that's what I mean. See, that's what I mean by a good, there's no such thing as the best strategy, right? Invoker is a good hero, but doesn't mean that if you don't have an Invoker, your team can't win. Okay, so reminder for the challenge, bear in mind that the prices that you will see on the platform are delayed 10 to 15 minutes. However, if you somehow have an avenue to see live prices and you place an order in to buy at the market price, you will be filled at the actual market price. Also, remember that the challenge is 8 weeks long, so your trading plan will have to be built around these parameters, right? So meaning you don't go and buy a stock and think and saying that the trading plan is that this stock is undervalued and it's supposed to be profitable in the next 4 to 5 years, right? The challenge is 8 weeks long, right? So at the end of 8 weeks, your P&L is this, your P&L is that, right? You're not going to take into account for future plans or where the stock is heading. Lastly, at the end of the challenge, right, we will not take into consideration for grading on any open positions. That being said, we need all your positions to be squared off by the end of the challenge. So again, here are some keywords you can read up for extra knowledge. Just need to Google this keyword, right? Number one, you can Google about Fibonacci retracements, aka the golden ratio. Next, you can Google about harmonics trading. It's originally an FX strategy that's built around Fibonacci. You can Google about trend following, or you can Google about breakout trading. All right, hopefully by the time you finish Googling all this stuff, the Google algo starts to pick up on what you're looking for, and then sooner or later, all your Instagram and Facebook start to see similar trading related stuff. Please do not search for the best trading strategy online. It does not exist. If it does, anybody and everybody will be rich, right? There's probably hundreds of trading strategies out there. My idea of having you to look at them is so you get a feel of how do people plan for their trades and what are the considerations, etc. Okay, let's do a little social experiment, right? Bear with me on this. This is originally used as a personality test, right? Invented by Tadahiko Nago and Isamu Saito, 2 Japanese university professors. Now, I'm going to use a very brief version of this to demonstrate how each of us perceive the same thing differently. And this is very relevant to what you're going to hear next. All right, so imagine you're in the desert, right? And to help you out, just stare at the desert that I have up for you. Imagine you're in the desert, and in this desert, you see a cube in the desert, right? A cube. Okay, I want you to really visualize it, where the cube is, okay? And where the cube is, now there's a ladder beside it. Okay, so beside the cube, there's a cube in the desert, and beside the cube, there's a ladder. You see it, right? You see the cube, you see the ladder. Okay, now I tell you that there's a horse. A horse appears in the picture. Okay, feel that, just visualize it. All right, a cube in the desert, and beside the cube is a ladder, and then there's also a horse in the picture. Okay, now take a mental screenshot. Okay, so I'm not going to tell you if you're an ENFP or an INFJ with this, right? But ask your friends, what was their cube like? Was their cube palm size? Was their cube the size of a man? Was it a clear cube or was it a solid cube? How about the ladder? Was it leaning against the cube or was it on the ground beside it? Or is it far away from the cube? Again, the horse, was it on the horizon? Is it far? Is it near? Did they have a saddle on? All this kind of stuff. So at this point, I'm sure you'll find many different answers, right? We talk about the same thing. a cube in the desert. Beside the cube, there's a ladder, and then there's a horse. But if you ask around, right, everybody idea of the cube is going to be different. Some people were going to say that the cube is a small cube, handheld size. Some people imagine a giant cube in the middle of a desert. Some people imagine the cube to be made of metal. Some people imagine a cube to be made of glass, etc. So bring this back to trading. Tell me, what do you see? All right, just take a while and look at this chart. This chart of Walmart. What do you see? Okay, now, do you see a stock that has fallen from highs and is now sitting on support? Well, someone else might see differently. Someone else might say, hey, this is a stock that has broken an uptrend and is now in a downtrend. So confirmation bias, this is a huge trap for beginners. Confirmation bias is when you read something new for the first time, right? And then you start to notice it everywhere, when in actual fact, it has always been there. This is where what you believe overlaps with what is actually happening. Example, you're looking at a new indicator that you read online, and people rave about how this indicator made them millions. And in your reading, you read about an indicator called RSI, or Relative Strength Index. So the gist of RSI is this, is that when the indicator is below the lower band, it's time to buy. And when it's at the top of its band, it's time to sell. Okay, so we plot out the RSI and then we see, hey, you know what is true, right? I've marked 3 lines here in the chart where RSI was above or below the upper or lower bands, respectively. Hey, you know what? RSI works. This is confirmation bias, example, right? Completely ignoring the number of times it doesn't work, or other variables, such as how often does it even reaches these upper or lower bands. Okay, so that aside, now let's talk about having a watch list. A watch list can consist of anywhere from 5 to over 100 stocks. People can have multiple watch lists to execute different trading plans. And there are thousands of stocks in the market. No way you're going to screen through all of them every single day, right? So you start first by filtering it through a screener. As what Beanie has covered in the earlier webinar, what a screener is. You can screen it by conditions such as volume, PE ratio, how many percent has it been up or down for the month, for the year. Or if you don't know where to start, I suggest you start with the 30 STI stocks for Singapore first, or with the mega cap stocks for the US market. Mega cap stocks are stocks with a market cap of over 200 billion or more. Those are your common names like Google, Apple, Amazon, etc. Right? So through your research and study, you find that you want to stick to, could have one watch list for stocks that are due for earnings soon. And you could have another watch list for the energy sector, right? Because we're heading into the winter months, and you think that as we go into the winter months, there will be an increase in earnings in the energy sector, right? So you have an energy for earnings, you have a watch list for energy. Okay, so what do you do with a watch list then? Now, you put all the stocks in the watch list, and every day you just screen through them and just spend no more than 5-10 minutes on it. Now, let's assume that your trading plan is to buy on support, and you identify a level of support like this, right? Clearly, the trade is not due for execution yet, because this is not where I want price to be, right? I want price to be on the line. I want the price to be on support. So what do you do then? Then this stock will go into another watch list, which is like, just an idea that this stock can be on another watch list that is, you can call it happening soon or something like that, right? And every day you only need to spend a few minutes looking at looking through your watch list. So a few days later, you see another stock in the watch list and it has hit support, right? Like this. And what do? Well, you execute it, you follow your trading plan. And that's how you use a watch list, right? All the homework, research, preparation, heavy lifting is done here. And across the days during the challenge, you will just skim through your watch list, taking no more than 5 to 10 minutes to see if your entry is ready. Right? That's why we want you to prepare a trading plan. You prepare a trading plan first, you know what you're looking out for, you do your watch list, and every day you just skim through it. Right? You're not going to spend like hours, you're not going to spend hours every day to like look through thousands of stocks, and when you see something, then you start to think of how I'm going to enter, what price, when I'm going to exit. All this work is done before you even look at the market. So bear with me here, right? Imagine you are a foreign student in KL. And since you arrived, KL has rained 5 days in a week. Do you think that 1 week is enough exposure for you to conclude that it rains more than half the time in KL? Using the same analogy, across the span of 2 months, you move about interstate for a few days each. You travel to Penang for a few days, Malacca for a few days, Cameron Highlands for a few days, and wherever it goes, sway the rain follow you. Now, is it fair to conclude and assume that it rains more than half the time in Malaysia? Not a perfect analogy, but my point is this. You need to respect your trading plan. Of course, you have more than one trading plan for different scenarios. You need to repeat enough number of times for you to conclude and say, hey, you know what, I tend to do better in support and resistance trades. Or things like I have a win rate of 60%. You can't do like 2 or 3 trades that both happen to be a winning trade and conclude that, hey, you know what, I found the golden strategy to make money. Which brings us to the second point, trade journaling. So trade journaling is where the hard work lies. Once you have enough data sets, you can see on the border picture, what are you doing good, what are you not, how to change, what to change. Later, I'll be sending a very basic template for trade journaling via Telegram. Feel free to add another column to record other variables. Like example, if you take a trade in Facebook, which is a tech stock, how is tech performing as a whole, right? Yeah, are you looking at the ETF for tech stock, which is XLK? Or what is the overall market index doing? Is it up or down? And now that you've done enough trades and you have a good statistical pool, it's time to study your behavior and tweak your trading plan. I'm going to be real with you, right? As far as trading is concerned, not everybody makes money trading the market. People have lost fortunes in the market. Even the most conservative people I know lose money. Chances of real success is slim. And you're probably not going to get it right in the first attempt. But the idea is this, right? You study, you prepare, and then you execute. If you fail small. And then you tweak, you adjust, you prepare, and you execute again until you find your edge. And that's when you can start to scale up. Now, but if you are investing, right, which is typically a longer term approach, then there is not so much of study and tweaking portion anymore. But having said that, you still need a plan. Even if you are an investor, buying and hold is not a plan. Yeah. Okay, again, I will be releasing this onto Telegram later. So when you do actually use it, be sure to delete the first 2 rows. That's for example only. There are 4 tabs to use here. One for longs, Singapore market, one for shorts, Singapore market, one for long US market, and one for short US market. For those who still don't know by now, short, when people say short, when I say short, I mean to sell the market. So instead of buying, hoping the stock to go up, you can actually sell, hoping the stock to go down. And if you don't know what that means still, you should read up about the term called shorting. Okay, so use the 4 tabs, put in your entries, and I suggest for your own good, you take a screenshot and save it on a separate folder. Take a screenshot of your trades before, take a screenshot after. Okay, so from here on forth, the number of things you can do and possibly analyze on is endless. Here is a guide for you to start the ball rolling. Did price go higher? Meaning like after you close your trade and you record them in the journal, you look back a few days later, did price go higher? When you were stopped out, that means when price hit your stop loss, did price reverse there? So when you ask yourself these questions and you review your trade journals, you need to practice a bit of hindsight. Hindsight means you look at your results, you look at the market now, and you tell yourself, hey, I should have whatever. I should have whatever, right? Don't practice hindsight after every single trade. Follow your plan all the way, right? And when you have enough data sets and when you have enough of a statistical age, then you practice hindsight. Then you tell yourself, I should have what, right? Now that you looked at your trade journals and you have told yourself, okay, I should have not got in so early. I should have waited for price to drop till where. I should have exit where, right? Now this is where you adjust your trading plan. So your new plan is you put all the hindsight into your new plan and then say, okay, my new trading plan, I'm going to enter how? I'm going to exit where? I'm going to buy based on what? All right. And then you do that again. You do enough trades. You do like another more, gather enough of a sample size. And then you study again, hey, am I improving? Am I the same or am I doing worse? So back to the rain analogy, right? Don't be the guy who travel Malaysia, KL, interstate 1-2 days, and just because it rains a few days, he says Malaysia is a place that rains more than half the time, right? Don't be that guy. Be the guy who has done enough trades, who have enough statistical pool to conclude such data sets and say, hey, I do better in which markets. I tend to perform how many percent of the time. This is my winning ratio, stuff like that. When you start to improve, when you see results, then you scale up. Right? What most people mistake is that they come into the market and they have a mindset, okay, I have $5,000 and I'm going to learn this. If I fail, I fail. That's it. Hey, no. Most likely you're going to fail if that's your approach. You need to repeat a number of times until you find your edge. And this is how you do it. So from your trade journal, you are going to have some trades that are good. And those really, really good trades, I suggest you move them into a separate journal for entry. So in this separate journal, you're going to record your best place. You can call it, the secret sauce or whatever. And you need to record them down in greater detail, because 1 year, half a year, 1 year from now, when you look back on your winning trades, all you will know is, hey, I made money trading Tesla. I made money trading Facebook last year, but you won't remember what causes it. What was the market conditions back then? What was my entry based on? Emotionally, how did I feel back then? So you start with a macro view, right? Macro views are views on the bigger picture. So you write in a journal and comment what happened. Was it Russia declared war? Was there a surprise rate hike? Was it sanctions, or etc. Parts like that. Next, was it because of fundamentals? Was it because earnings was good? Was there news on new technology, on government support? And then you look at technical analysis. What kind of technical trade was this? Was this buying the dip, or was this a breakout? Risk management, how do you manage risk? Did you add more? Did you scale in? Did you scale out? Was your profit target good? could your profit target be higher? Is your stop loss too tight? Should your stop loss be looser? And then this is to compile everything into a trade review. Now, why do this, right? Because half a year, 1 year, 2 years down the road, you'll probably fall into a ditch again, and then you probably start, I mean, if you sway, you're going to start losing money again. That's when you need to study the trades that you do best. So you study these trades again, you remember that, I traded these stocks because there was a proper fundamentals behind them, because there was new technology, there was government support. Now what I'm doing is I'm doing this, because you see, winning is an addiction. Winning too much makes you feel like you know everything. And once you reach that level, you're going to start buying stocks for nonsense reasons. So eventually you need this journal to anchor onto what works for you. Okay, I'm going to go through with you a sample trade that I did earlier this year, and just a sample trade to demonstrate how I will record down my journal. But before that, give me a minute. Let me see this here. Okay, very quickly, just answer a quick question here on YouTube by Riley G. Shep. How much is enough data sets? Well, I would say, a safe answer is 100 trades. 100 trades would be a good enough data set. So if you are profitable out of this 100 trades, and you are profitable 60 times out of 100, then it's easy to compute that whatever strategy that you're doing, it works 60% of the time. But right, that depends. Again, this is a function of the frequency of your trade. So if you are intraday scalper, like you do like 4 or 5 trades a day, you could hit 100 trades easily, then I suggest you just stick to 100 trades. However, if you are a swing trader, you want to practice swing trading, where you will swing stocks up and down, for like days or weeks. So maybe in a month, all you do is 1 or 2 trades a month, then a good data set will be about 1 year's worth of data, because 1 year is a full financial cycle. So I say maybe about 20 trades. Yeah. So again, it depends on the frequency of your strategy. Now, like I said, you are and you will have more than one trading plan. So whatever plan you execute, that plan. So what I'm saying is, you don't have a plan for scalping, right, where you do 5, 10 trades a day, and then you have a plan for swing trading, where you do 1, 2 trades, 2, 3 trades a month, and then you combine these 2 data sets and say, hey, I have enough data set. No, okay. Your scalping data sets, you compute that, you study that, you tweak that, and then you work on that, right? You don't combine your data entries from your scalping trades and combine it with your swing trades, right? Because it's not an apple-to-apple comparison. So you do one enough, and then the other one that you do, right? If the trade frequency is low, then the data set, I would suggest just use reference of a year. Okay, so here is a sample trade, right? The macro view is this. China has had 0 new COVID cases for the longest time. I'm not talking about now. I'm talking about like earlier this year. So it happened on 24th April. Right, 24th April was a Sunday, and okay, I'm not so hardworking to look at news all the time, even on a Sunday, but because I constantly search for this kind of things, because constantly I search for trading and investment stuff, related stuff, right? When you scroll Facebook will start to pick up your algorithm, and they will feed you things like Reuters and stuff like that. So this kind of thing is like a double-edged sword. It works to keep you hooked on Facebook. At the same time, I don't have to search for news come to me. Okay, so I happened to see this trade, to see this news. So from January until April, there was no new COVID cases. Listen, I'm saying there's no new COVID cases in China, right? 24th April, suddenly this piece of news come out that COVID-19 cases jumps in Beijing and new deaths triple in Shanghai. Okay, so given that China was the source of COVID-19, right, a headline like this on a Sunday will send panic through the market. True enough, that day Asian markets closed red for the day. Now, with that as a confirmation, I was expecting a similar result in the US markets. And I was looking in particular for a clean setup for a trade in the energy sector. I want to look for something that has kept down into support, preferably something that is already in a clear uptrend, which shouldn't be a problem because ever since Russia declared war on Ukraine and the US has imposed sanctions on the price of oil, oil has been on the way up. So I also don't think that this new surge of COVID cases will affect anything fundamental for two reasons, right? Number one, there are sanctions on Russia, therefore limiting the supply of oil. Therefore, the price of oil should go up regardless of it, because Russia is one of the big players in OPEC. Most of the Western world has already relaxed their COVID restrictions and people are already starting to travel more. So from the world's point of view, COVID is more or less like coming to an end soon. Right? But because a news like this come out from China, people are panicked, thinking that it's the third wave. So what happened is there is no new fundamentals, no new change in fundamentals for this trade. There was no real material change on anything. Essentially, it was a systematic risk. Systematic risk means that the overall market gets dragged down. It doesn't matter how strong the company is or how much profits are there, how much cash flow you have. When systematic risk occurs, everything gets dragged down together. So I have a watch list for oil stocks. And the moment US declared sanctions on Russia, oil stocks have been on an uptrend along with the price of oil. So for this watch list, I was looking for pullback for me to trade in the direction of the trend. For those of you who don't know, a pullback in the uptrend means that when the stock is like trading up, pullback is the price just drops momentarily and then it goes up again, right? Pullbacks happens all the time. But so using this ExxonMobil example, right, you see that it was trading around like 85-ish area. And on the day of the news, it pulled back. It dropped to 82.26. Right, so that's a pullback. In fact, this is a super clean pullback. So the news was on 24th April. It was a Sunday, right? I let the market do its thing on 25th April. After the US market closed, I was looking through my watch list again on the 26th, right? So the news happened on 24th. 25th, I just used the Asian markets as confirmation that this is going to send panic. And then basically I do nothing on 25th April, Monday, because I was looking at the US market. So I don't anticipate what's going to happen. I wait for it to happen first, then I do it. So 26th April, I was looking through my watch list, right? And then I saw a nice trending stock up that has gapped down and is now sitting on a 50-period simple moving average. Remember Tom Yen's lecture when he talked about moving average, about fair value? Yeah, this is it. So looking to the left of it, right, you also see that not too long ago in March, let me just bring up my laser pointer. So it traded here, it pulled back to this 50-period moving average, which is the red line. It pulled back, it stopped. Just nice sweet over here. You look to the left, you see that this red line has held support over here. So in a sense, you can say that this red line worked before, right? Obviously, it did not work all the time, right? But I'm using this as a reference. So more importantly, this candle did trade past the 50 moving average on the day, but eventually it still closed where it opened. This indicates strength, right? Keyword, indicate. Indicate is not an absolute. Right. So what I mean by that, what I mean is that on this day, right, the stock gap down from yesterday. Gap down means that it just dropped, forming this gap here, hence gap down. Right. You see this red line here, right? This red line is formed because throughout the day, the stock traded. It went all the way down to this level here, the end of the line. And then by the time the market closed, the stock market pushed back the price back all the way up here. Therefore, it formed that line. So this is an indication of strength, you see, because like there was panic in the Asian markets, there was panic in the US markets, everything gapped down. But on the day itself, the price of ExxonMobil still closed at the same place where it opened, despite trading down throughout the day. So this is my setup, right? I am buying on dynamic support. Dynamic support means basically your moving average, your support levels that is constantly moving, hence dynamic support. Stop loss is slightly below the previous day low. So this candle is my entry, my basis of entry. So my stop loss is just slightly below this level. If you remember Beanie's lecture, she uses ATR as a reference for stop loss. ATR stands for average true range, for those of you who forget. So you can use the ATR to measure your stop loss. But for me, I just like roughly estimate like a little bit away from the lows, and that will be my stop loss. So we can see that since the start of 2022, over here, since the start of the war, the stock ExxonMobil, right, has not spent one single day below this red color line. And this red color line again is the 50-period moving average. So hence this is my theory that if ExxonMobil starts to trade below this red color line, then to me that is an indication of change, and therefore I would think that I will use that as a reference. So if price starts to trade below the 50-period moving average, then to my point of view, I will accept that this is a change of trend. This uptrend is no longer validated, and therefore that will be my stop loss. Profit target was set at last high over here. This gives me a risk reward of about 2.93. Right, risk reward means I am risking this amount here. Right, I'm risking this amount to gain this amount, and the distance between here and here is 1:2.93. That is risk reward. So I'm buying this stock at 82.26. My stops is at 78.61. I am risking $3.65. Profit target is set at 91.66 for a profit of $9.40. So for every stock that I traded in, that I will trade in this, I am potentially risking $3.65 to make a profit of $9.40. So quick exercise to recap. My entry is 82.26, right? Stop loss is at 78.61. Therefore, I'm risking 3.65. That's right. So if this is your demo account reference, right? Your demo account, you will have $5,000 Sing as a base capital. Approximately that will give you USD $3,600, assuming you will use the 1% risk method. 1% risk is 36 US dollars. How many shares will you buy then? Right. So again, how we get to number 5 is 1% risk. Right. 1% risk is a hypothetical example, you can risk 2%, 3%, 4%, 5%, whatever, right? Of course, small risk, small return, big risk, big returns. So you risk 1% of your base capital, $5,000 Sing is approximately USD 3,006. 1% of this is USD $36, correct? So you are risking $3.65 per share. Total you can risk if you are using a 1% risk is $36. How many shares will you buy? So here's the answer. 1% risk, you will risk 9 shares. If you're risking 5%, you will buy 49 shares. A lot of new people have this misconception that the more shares I buy, the more I will gain, right? It doesn't matter how many shares you buy. True, you might gain more in dollar value in terms of overall account size, but when we are talking about positions, the gain per position, right? A $5% gain is a 5% gain. Doesn't matter if you buy 100 shares or 1,000 shares. 5% gain is still a 5% gain. Rally G-Shap, yes, 9 shares. Yes, correct. 9 shares of ExxonMobil. For the US market, you can just buy 1 share. Unlike Singapore and Hong Kong, we have lot sizes. So for Singapore, most stocks go in lot size of 100. That means you have to buy multiples of 100, 200, 300, 400 shares. For Singapore, for US, you can just buy 1 share, 2 share, 3 share. Price did eventually hit my target. So you see, here was my entry, right? I buy here, stop loss here. It did trade, ding, hit my target, right? So I take a screenshot of this. I record this down in my journal. This is a winning trade. Now, if you look at this screenshot, right, and you practice a bit of hindsight, could I have done better? The answer is yes, right? I could have done better. I could have done better on 2 occasions. Number 1, I probably should not have got out all my positions because since I could have let the positions run further. I could have scaled out. To scale out means instead of exiting a full position, I exit maybe 80% of it and let the other 20% run. Again, if you look closer, you see that when it hit my profit target here, price did actually drop down again to the 50-period moving average. And I could have entered again one more time here and make a profit here. But I did not. What I did was, once the profit target hit, ding dong, this trade is done. I have made money. I record down in my journal, and that's it. I look for the next thing to trade. So this is when you practice hindsight. Psychologically, this was a fairly easy trade to manage. The moment I took the position, right, the moment I entered the position right here, it was trading up every single day, except for that one day it was down 3%. Although I was worried initially because the S&P was still falling at the time. But I found comfort in knowing that the ETF for energy was still trending up at the time. Excuse me. So things to note is that your best trades might not be their best trades. Why? Because we all perceive information differently. As you see in the experiment earlier, right, the tube in the desert experiment, you will find that your best trades only work a certain percentage of number of times. Having said that, right, let's address the elephant in the room. Is trading gambling? The short answer is yes, okay? But how you approach the market makes the difference if you are trading, investing, or gambling. Quoting my favorite fictional pirate, the problem is not the problem. The problem is your attitude towards the problem. The stock market, right? Do we know where will price go in the next 5 minutes, next week, or 5 years from now, right? You ask any expert, ask any economist, and ask anybody. If you ever have a chance to speak to anybody in an economic forum, just ask them, do you know where the price will go in 5 years' time? Nobody will give you a definite answer. Sure, people will say things like, oh, historically, this stock has performed from 1980 something to now. It has made an average return of 10% a year. So based on that projection, this stock in next 5 years should reach what level. But nobody can say for certain that 5 years from now, this stock will reach what price. Other than options, you can say that when it expires, it's worthless. So that's the problem, right? Where will price go? We don't know that. You can study the financials, you can look at their P&L, but does that mean for sure 100% of the time the stock will continue to perform? No, it doesn't. So where does that leave us, right? At least it adds a filter to it. So instead of looking at thousands of stocks trading in the market, you are now looking at hundreds of stocks. If you pay attention to financials, right? Because with the filter, right, and you look at financials, all those that are not profitable, out. So you now end up looking at a smaller sample size. So again, even stocks that are fundamentally sound, will they go up for sure? Nobody knows. But we do know that historically stocks are fundamentally strong, generally moves upward trending. So the longer you stay invested, the higher your chances are. To quote Tim Phillips, our head of content, if you stay invested for 10 years, your odds of a positive return would have improved to 93%. Having said that, just plainly holding on is not a strategy. Again, it's part of a strategy, but not all rounded. So here's a case study. This happens to be one of my clients here. Okay, the names have been changed for his PDPA purposes. So this guy named Ira buys 5,000 shares of DBS in July 2020 at $20.50. Has about 100K in value. He asked me if DBS is a good buy, to which I said yes. DBS has solid earnings, solid fundamentals, and they also have a presence in China. That means that their room for growth has potential to grow, right? If your market is China, your profits is sky's the limit, right? But if your market is only just Singapore, then your market is just 5 million population. By the way, China don't just allow anybody to set up shop. So back then, we were in the peak of the pandemic, and I told him that for DBS to grow, you need to give it time. At least 3 to 5 years, wait for the pandemic to clear when things go back to normal, because we are looking at the fundamental long-term play. But also, again, back in July 2020, right, news was constantly flowing with breakout here, breakout there, COVID clusters, stuff like that. So on 30th July, DBS gapped down 2%. And 3rd August, DBS traded lower by another 1.5%, closing at $19.45. That is about $1 of unrealized loss, which, if you think about it, is not that a big deal, because we are looking at the bigger picture, right? For 5,000 shares, $1 unrealized loss is $5,000. So his holdings went from $102,000 to $97,500. Again, if you see the difference in money in that, right? Sure, if you think about $5,000 is quite a big sum of money, but percentage-wise, it's not that big of a difference. So he calls me and frantically asks me, hey, bro, what's going on with the market? Are we going to drop again? To which I said, it's just normal market nuances. Up and down 2 to 3% a day during that time was quite normal. And then he said, hey, bro, but my DBS holdings went for 6% in value. Sorry, it went for 6 digits, and now it's 5 digits. Okay, well, if you want to put it that way, you're not wrong. But Ira, you are in it for the long run. Remember, when we bought DBS, the intention is to hold long term, at least till the end of this pandemic, when we go back to normal. Because this whole pandemic is dragging the market down. It is not targeted at any specific sector or industry. On 5th of August, DBS closed slightly higher at $19.83. And then IRA thought, hey, you know what? The market has bounced back a bit. I better get out while I still can. Fast forward to today, DBS is now trading at about $29. Though the pandemic is not exactly over, but we are loosening up for sure. I'm not telling you this case study to show you that I was right. This could happen to any of you. So let's review what was done wrong, what could have been done better. Was it that he bought too big of a size? Maybe. Maybe if the size was smaller, he won't be too anxious about it. Should he not look at price every day and worry too much? Because if your projection is a long-term projection, why do you need to look at price? You don't need to scrutinize every single price movement every day. Or in short, he had wrong expectations. Okay, here is another case study. Throwback to 2008, the most last major financial crisis. I don't know if the sentence makes sense. The most last major financial crisis, basically the second last financial crisis, which is the subprime crisis. Now, Madam Wong, who has been reading about Buffett, if you don't know who Buffett is short for Warren Buffett. And this one sentence that Warren Buffett says all the time: be greedy when the market is fearful and diversify across different sectors. So that's exactly what she did. That's what Madam Wong did. She studied Buffett, and during the subprime crisis, during the economic crisis of 2008, when everybody was selling, everybody was afraid, she went in and she bought stock. You would think that Madam Wong made money now, right? No, she didn't. So what did she buy? She bought into telecoms. She bought into property developers. She bought into water utilities, and she bought into shipping. Okay, for the sake of this exercise, let's assume that she bought this in equal value, meaning that she bought these 4 shares in value of $5,000 each. So that let's keep it as a constant so that we can calculate things better. 14 years later, this portfolio is facing a net capital loss of 30%. So she bought 4 stocks during 2008, during the second last financial crisis. And now, fast forward to today, when we are just recovering from that COVID crisis. In theory, she should make a lot of money because she bought since the second last economic crisis. But no, she is still in the loss of 30%, not including dividends. So what happened? You see, she bought Singtel at 256. When the second crisis happened again, it was at 257. Now it's about 270 something. City Development only made about 13%. High Flux, the stock went bankrupt, so it became worthless. Of course, High Flux did not become bankrupt overnight. It wasn't trading at $1. Just one day the market just opened and hey, High Flux bankrupt already. It was a slow deterioration to bankruptcy. And then Keppel Corp was the most profitable trade probably. So what is wrong with this trade? What is wrong with Madam Wong? It is crazy to buy and hold something for 14 years and end up losing money. How could this be? And how could this have been done better? Could she have picked better stocks? Maybe, right? Maybe, but during those points, right, even High Flux, even the stock that went bankrupt, at some point during High Flux history, analysts was writing good stuff about it. Analysts were saying High Flux is a good stock, that's good earnings, but still these things happen. Or maybe she should have kept in touch with the news, keeping up with earnings report and adjust accordingly. But not everyone is sensitive to numbers, right? And most importantly, she did not practice the second half of the statement. So the second half of the statement is be fearful when the market is greedy. So the full quote that Warren Buffett says all the time is be greedy when the market is fearful, and be fearful when the market is greedy. So perhaps the biggest problem here between these two case studies is this. As cliche as it sounds, is fail to plan. Obviously, the plan is to make money, right? But that's not enough. As you know by now, part of a plan is where your entry is and where your exit is. So the biggest component of a plan is to know thyself. For people like Ira, buying and holding long term is not a fit for them because of the nature of themselves, right? Ira is the kind of person who cannot, 100% cannot hold long term. Ira is the kind of person who must look at a shorter time frame. He should be buying DBS. When he's buying the DBS, he should be looking at something that is like, I expect to take profit like a few days, a week, 2-3 weeks from now, because that is just his personality. You can't change it. If you ask Ira to hold a stock for 3 to 5 years, he will go crazy. He will look at prices every single day and he will like, hiya, I should have bought lower. Hiya, I should have sold just now, stuff like that. You drive a man mad. And then what Madam Wong was lacking was essentially a plan, right? She did buy during a crisis, that's good. She did hold on long term, that's good, but she did not have an exit plan, right? You're not going to buy and hold stocks until it drives to zero, right? You do need a plan for long-term investing, but some adjustments must be made. Having said that, long-term investing, we talk about entry, right? But we no longer talk about how much % risk your portfolio you go in with, right? With long-term investing, we don't talk about that anymore. Now, depending on how much you have, you could either plan to enter on a dedicated fixed amount of money periodically, or start off with this amount now and buy and hold into a later, longer term date. With longer term investing, it doesn't make sense to have a stop loss anymore, right? Because you are looking at long term. So 1% stop loss, this kind of thing, don't apply to long term investing, because your strategy now is to let time do its thing. So what you need to consider is this. Oops, sorry, a little too fast. What you need to consider now is this. What is your drawdown strategy, right? Highly unlikely you will buy at the lowest possible price. So if you are lucky, price starts to go up the moment you buy the stock. But for most of the time, it's probably going to drop. So what do you do? If you buy a $50 stock, right? Does it make sense to buy again at every 20 cents? So you enter a stock, it's at $50, and then it traded lower. Now it's at $49.80, and then the next few days it's at $49.60. It went down by 40 cents. For a $50 stock, for a $50 stock, does it make sense to enter at every 20 cents interval? Bro, you'll go broke before the stock even reaches $30. Or do you want to go in by a certain percentage? For example, every 10% drop, you will buy the stock again. That is a similar strategy to dollar cost average, but except that this time you are willing to buy at the dip. Most of what works depends on your personality. In Ira's case, it would have been better if he had approached the market with a plan to average down, be it by the dollar value or by percentage. Then he wouldn't need to stare at price every day and scrutinize every single tick the market is making. Again, you might also want to consider having a bear fund. A bear fund is money that touched when the market is in absolute panic, like in 2008 during the GFC, or back in March 2020 at the peak of the pandemic. So panic means, what does panic? Panic is like, when circuit breakers are triggered, right? Circuit breakers are actual mechanisms in the market that prevent the market from dropping too much within a day. So if a certain stock drops by X number of percentage during a day, it will trigger a circuit breaker and that stock will be suspended from trading for the day. So when you hear news like circuit breaker has been traded, yeah, we are most likely in a panic state. or you see news that stock index gaps out 2 to 3 days in a row. So this is when you have a bear fund and you take out the bear fund to start buying stocks, right? Instead of like every day look at the market, oh, it's up down 0.5% today, or this stock is up down to 3%. Every day you just stare at the market waiting for this. You have a bear fund, that's one strategy. The bear fund strategy, you have a bear fund, you keep it in the bank. And one day when you see the news and hey, economic crisis, market down how many thousands of points, hey, that's when you start to enter the market. So that is a plan. Lastly, where to exit. Again, as much as you can never buy the absolute bottom, you can never sell at the absolute top as well. But at least don't be like Madam Wong, who hold a stock from one crisis to the next. And I hear this over and over again on the trading desk. Clients call me and they tell me that, hey, I will accumulate it for long term and I will sell it when I'm older or ready to retire. So their plan is this: I'll just keep buying stock now, right? And I will sell it when I'm older. Okay, but what if, Auntie, by the time you are ready to retire, we are in another crisis? Are you going to keep working? So in a perfect world, whenever I buy something, it will be the lowest. And whenever I sell it, it will be at the highest. But when a price drops from 20%, how much does it take to go up to break even? This means, example, let's use 50% gauge as an easier reference. If a stock was trading at $100, it's trading at $100 and now it's trading at $50 because of the crisis. That is a 50% drop, right? So if you enter the stock at $50, buying it, and you expect the stock to go back up to where it was before, how much percentage move is that? That, my friends, is 100% gain, because from $50 to go back to $100 is 100% gain. So the idea of a bear fund is this: instead of staring at stocks every day and staring at prices every day, you just have a pool of money that you tell yourself, hey, I will buy stocks when the market has dropped. How much? 20, 30, 40, 50%. You decide on the value, right? During the 2008 crisis, markets dropped 30%. The most recent COVID crisis, the SPY dropped about 20%. So far in my lifetime, because I'm still young, but I've not seen the market drop 40, 50, 60, 70%. And if the market dropped to 90%, bro, I think there's going to be riots on the streets, man. So don't think about a stock dropping this much, because if it even dropped 50%, I think it's absolute madness. So let me just get a sip of water. So look here, this is a downtrending stock. This looks like a bad, shitty stock. But actually it's not. This is a very strong stock. This stock, strong as in strong fundamentals. Strong fundamentals, that means their earnings is good, their P&L is good, their net profit is positive, is up year on year. This is in fact Xiaomi. So why will a stock, despite having those characteristics of what I just said, look like this? This is because of market nuances. Hong Kong in general, mostly due to geopolitics and government-related stuff, it went from as high as $35 pre-pandemic to about $12. That's a 70% drop again. I say that is madness. But then again, Hong Kong is that volatile. So if Singapore, if a blue chip stock in Singapore drops 70%, right, that is madness. But Hong Kong is like, meh, another day, because Hong Kong is that volatile. you would have grown if you were buying into this stock, right? If you're buying into Xiaomi and you look at the fundamentals, you look at the reports, and you say this is a strong company, Xiaomi produces good electronics. I use a Xiaomi vacuum cleaner at home. It's really useful, it's really good. And your drawdown strategy, right, is to buy at every $2 drop. So from $30+, it drops $2, I will buy. It drops $2, I will buy. It drops $2, I will buy. At some point, you will stop buying one. At some point, you will think, hey, this is madness, bro. Every time I'm putting money in, I'm losing money. I'm putting money in, I'm losing money. And you start to ask yourself, is the market rigged? What is going on? Does the world hate me? So if, however, you approach the market and tell yourself that, hey, I will buy this stock at every 10% drop. So from here to here, drop 10%, I buy. Here to here, drop 10%, I buy. Here to here, drop 10%, I buy. Right? You would have averaged down so much that by the time every time the stock recovers a bit, you can sell. It goes up a bit, you sell. Goes up a bit, sell. So if you are good, if you're a professional trader, you still can make money in the down market. Of course, if you're trading CFDs, you can also short the market. So this guy, John Maynard Keynes, the man who's responsible for the theories you study in the economic textbook. Market can remain irrational longer than you can remain solvent. Again, a fundamentally strong stock does not mean that it will only go upwards. So how do you survive in the playing field like this? Simply put, risk management. So recap here, right? We talked about the best strategy, right? How there is no best strategy ever exists. A quick reminder about the competition dynamics. We went on to talk about Cube in the Desert, where you get a sense that we are all thinking about the same thing, but how we interpret that is different, which leads us to confirmation bias. When you look at something for the first time, remember to look at the bad side of it as well. Okay, and then we discuss about building a watch list, right? How to build a watch list, how to use a watch list. So the idea of a watch list is that you do your homework first, you put them on the watch list, and every day you just look at this watch list. You don't go and look at all the thousands of stocks every single day. The 3 keys to success, right? That is to have a plan, trade the plan, journal your trades, and study your trades. Right. Lastly, I give you a case study about 2 clients of mine. One size was too big, and he lost money in the stock that was making money. And then we talk about long-term investing. How long-term investing is different from trading, obviously, but some of the rules of risk management still applies. Like you need to plan your entries, your exits. Exits being like when you're wrong and when you're right. Of course, if you're holding the stocks for dividend, if your plan is to buy and hold stocks for dividend, and my plan is that I will accumulate this portfolio of this basket of shares, and I don't care what the stock price is because I'm using this portfolio to generate dividends for me as my retirement income or as my second source of income, then I don't really have an exit plan per se. But maybe you might want to have a plan for extreme cases. Like example, like extreme case, if the stock suddenly goes up by 8% within a day, I will sell. Yes, that's an extreme case. Stuff like that. So to end this off, I will leave you with a quote from Star Trek. It is possible to commit no mistakes and still lose, right? It's not a weakness, that is life. And we have come to the end of this webinar. Do stay in touch with us on our social media site. On the left is what our Prosperous social media, and on the right, you get to look at Prosperous website to get to know more about our products and services. So if you find this webinar useful, do give it a like so that we know how to give you more content that you like coming your way. Now that we have come to the end of the webinar, I'll take any questions if there's any. So I remember a few days ago, there was a question from UWU, UWU. So weird for a guy to say UWU. UWU asked about is technical analysis similar to astrology, right? Hello? Yes. Is technical analysis similar to astrology? So to that, I would say, right, if you are looking at astrology on the aspect as like, okay, example, I don't flame me for this, but I don't study astrology. But example, right, Virgo tends to be what, or Leo tends to be what. People people who are Capricorns tend to be what. Yes, in that sense, you can say technical analysis is similar to astrology, because if you look at example, using that as an analogy, right? Let's say in technical analysis, we have this thing called chart patterns, right? So we have chart patterns like flags, inverse triangles, breakout, double top, double bottoms. All these are patterns, right? So if I, using the analogy, and I say that is flags, breakout flags is a tendency of a trend continuation. And yes, you can say that this is a similar aspect of astrology in that sense, like this pattern tend to be like this. This stars, we born under this stars, we tend to be like this. Of course, there is that. I'm not sure about if astrology has a standard deviation, room for error. Obviously, not 100% of Capricorns behave like this or whatever. Same like technical analysis. This chart patterns or what that people has predefined, and they say that this is a pattern for what it works X percentage of times. It's not 100%. It's an indication. It's an indicator. It's not an absolute. Where do we submit our trading plan? Okay, so trading plan updates. So I've sent you guys the templates. I've sent you guys examples how to write a trading plan. Again, I don't advise you to finalize your trading plan so soon. Look through the market a bit, study a bit more before you actually finalize your trading plan. But eventually, your trading plan will be sent to us via email. More instructions on that will come in the later days. There is a specific format that I want you to send your trading plan in. That means I need your trading plan, your email subject, to be in a certain format so that the emails can flow to me directly. Otherwise, I'll be expecting thousands of emails and my mailbox is going to hang. Right. So just hang on to Telegram. It will come on the next few days. What is the app we are going to use for trading? Okay, the app that you will use for trading is our in-house app called Prosperous. Prosperous, we will be using a demo platform. So the markets are real. The market data that you see will be delayed. But the money that you're trading is fake in that sense. Login details will come to you on 16 September. So you will have time to play around with the platform, click a buy here, click a sell here, see what happens. If you do this, if you do that. From the time you receive your login credentials till the time of the challenge, play around, do whatever. When the challenge starts, everything will reset back to the original setting. Do I still play Dota 2, bro? Sometimes. Sometimes. But I'm more of a CS guy. Is it possible to take partials on Prosperous? Okay, so the thing about CFDs trading, right, is that everything you buy, think of it as a bundled contract. So if I buy 100 shares of something, right, that is a bundled contract because that's how CFDs work. I buy 100 shares of, let's say, Amazon, right? I buy 100 shares of Amazon and I plan to scale out. To scale out meaning I plan to take 20% profit here, take 20% profit higher and take the rest higher or whatever. Meaning I buy 100 shares, I will exit 20, 20, 20, 20, 20, 20. Now, can you do that? The short answer is you cannot. However, you can take, what you do is you buy 100 shares, and then when it reaches this level, you sorry, you buy 100 shares, it goes up, you short 20 shares, right? And then eventually, if it goes up higher, you short another 20 shares. So essentially, you're holding 3 positions. You are long 100 shares, you are short 20 shares, and you're short 20 shares. And then your last trade, you are short 60 shares. That's when you actually get out of your full trade. Now, by doing so, right, you long 100, short 20, and short 60. Mathematically, when you close out everything, it works out to be the same as scaling out. That's just how CFD works, because CFD has margin and leverage, right? So when you buy, whatever you buy at the first instance is bundled up as one contract. So it comes as one. When you sell, you have to sell the whole thing, right? You cannot say partial, but what you can do is you can buy, short, and then when it's your full profit target, then you close out everything. Mathematically, it adds up to be the same. Okay, for the competition, will shorting the market when company that gives bonus issue cause it to become a loss? No. When you short the market and company has corporate action like rights issue, stock split, stuff like that, your short positions will automatically be priced in. So say, as example, Tesla was trading at $900, short Tesla, right? And Tesla had a stock split of 3:1. So the stock went from $900 to $300. And that does not mean that you short 900, which become 300, because it will factor in the number of shares, and then essentially your number of shares would decrease also, right? So it adds up to be the same. When shall one pay for the share in the trading game? When shall one pay for the share in the trading game? Okay, I don't know. I don't think I really understand your question, but if you're talking about when are you paying real money, the answer is no, you are never going to pay real money because this is a simulation. But if you're asking about when will your so-called fake money, your simulated funds be debited when you enter a buy trade, the answer is immediate. May I know how much leverage we are allowed in the 5K amounts? Okay, so first of all, the 5K amount is Sing dollars. How much leverage will be allowed depending on stock to stock? So on 21st September, my colleague Jadif will be conducting a webinar called Tools of the Trades. And in that webinar, he will teach you how to use the platform, how to read certain information. And one of this information that you will read is about how to read margin. So I assume you understand what's leverage, right? Margin and leverage is like I can't think of an analogy for margin and leverage, but basically they are hand in hand. Without one, there isn't the other. So you will know the margin of the stock first, and different stocks have different margin levels. So example, I could be wrong, but DBS could have a margin of 10%. So meaning that if you're going to buy $5,000 worth of DBS, 10% margin means you only need $500, right? So if you use $500 to buy $5,000 worth of DBS, then your leverage is 10 times. I think at most your leverage is 10 times. But not all the stocks is 10% margin. Some stocks can be 20% margin or what. Okay, so when I scale out from my long positions fully by taking shots, it will cancel out my orders automatically. No, it will not. So you can, what can happen? Okay, the way CFD works is that you can long 100 shares of something. For example, you can long 100 shares of Amazon, and at the same time, you can short 150 shares of Amazon at the same time. So you long 100 shares and short 150 shares. Logically, most people would think that these two should X out one another, and all you're left with is short 50 shares. But no, because this is CFDs, this is recognized as two individual positions, a long 100 shares and short 150 shares. So if you're taking a short on the same position, you are not going to close it. You're going to open another position. So if you long 100 shares and you want to close this position, right? Again, this will be covered in the other webinar. There is a button on the side that says close, and you close the position and this is gone. I think it's a bit hard for me to explain this now without looking at without having the real platform on your hands and without even looking at it. But more of it. So again, you will receive your trading credentials by 16 September. Remember to change your password. And then by 21st September, we will conduct a webinar on how to use the trading platform. All right. Let's see if there's any more questions. Did I miss out anything? Okay, now, if there's no more questions, then thank you, everybody. Thank you for your time. Thank you for being here with us tonight, this evening. And I see you guys